Hey, good afternoon. Thank you guys for showing up today to another installment in the Hanson Capital webinar series. Today, we're going to talk about the anatomy of a deal from first look to closing table, what actually happens between we found one and we own it. The thing I really want to stress here is the process really is what delivers our result. A lot of people can buy real estate and focus on the time, but the discipline of the process and how the sponsor moves through a deal is what we believe leads to the result more than anything. Before we go too much further, Chris Hanson, founder of Hanson Capital Group. We've also got Ted Ost, managing director of investor relations, and Chris Pike, the managing director of acquisitions. And Chris, go ahead, introduce yourself.
Sweet. Yeah, so as Chris mentioned, my name is Chris Pike. I'm the managing director of acquisitions here at Hanson Capital Group. Quick background on our firm. The firm was established by Chris Hanson back in 2008. Started in the residential space, buying single family homes at auctions, packaging them into portfolios that we eventually sold to institutions. Also started a hard money lending platform, a debt investment platform where we're doing a lot of lending on single family homes that helped with the auction business that I mentioned just a second ago. We also had a focus on multifamily did a lot of the existing value add apartment deals, whether it was executing the value add business plan or assigning a contract. We did between the residential homes as well as the apartment deals, did a few thousand doors bought and sold across the Sun Belt. We didn't start doing industrial assets until 2018 is when we acquired our first industrial asset, and then picked up a lot of speed in the industrial space in 2020 and 2021. At the time, the multifamily market was getting pretty frothy in the Phoenix area. People are competing on pro forma 4.5 caps, and we could buy some industrial outdoor storage assets at pretty attractive in-place yields and where we could arbitrage our debt. So we made a pretty big pivot into the industrial space. And that's what's led to our existing portfolio today. Today, we've got about 1.6 million square feet of assets across Phoenix and Texas, sourcing deals throughout the Southwest United States. And our focus today is on small bay, multi-tenant industrial assets or small bay business parks. With that, I'll kick it over to Ted, our managing director of investor relations.
Well, thanks, Mike. Before we begin, a quick disclaimer. The information shared today is for educational purposes only and does not constitute an offer to sell securities or solicitation to invest. Any potential returns discussed are not guaranteed and depend on the company's ability to execute its strategy as outlined in the private placement memorandum. Please conduct your own due diligence before making any investment decisions. So today we're going to ask for everyone to participate and submit questions. We'll answer the questions live when we can, and we'll address more at the end to keep progress moving. But we find these webinars are most valuable when the audience engages. So please, if you have any good questions, feel free to throw them in. Today, we're going to walk through every phase of how a deal moves from the first time we see it to the day we close and take ownership. We'll define and discuss each of the following stages throughout the conversation: sourcing, underwriting, LOI, which is letter of intent, purchase contract, due diligence, financing, and closing. Every one of these is a decision point, and at every stage, the answer can be no. So first, we're going to kick it over to Chris Pike with a question of, Chris, you have lots of relationships with brokers, you're constantly outsourcing deals, but how do deals actually show up on your radar?
Yeah, so the way deals show up on our radar, they show up through a variety of manners, but it really boils down to relationships, whether it's with sellers themselves or broker relationships within the market. A huge amount of our deal flow comes from our existing relations with brokers throughout the marketplace, and it's not just capital markets brokers. We work very closely with leasing brokers, who are also doing a lot of the heavy lifting with existing owners or doing some direct to seller outreach. Additionally, we see a significant amount of deal flow through direct to seller activity, whether it's someone we've already acquired an asset from, maybe it's an institutional owner that we already have a relationship with, as well as we do some marketing direct to sellers as well, specifically targeting assets that we want to acquire, seeing if they'd be interested in selling and presenting offers in an unsolicited manner. But in terms of, what it really just boils down to is relationships with the brokers, the sellers themselves, nurturing those relationships, staying in front of them, making sure we're doing our part to stay top of mind and being in the right place at the right time, and showing up and doing what we say we're going to do in order to establish a strong reputation within the marketplace. For example, brokers, they'd rather deal with someone that they know, like, and trust and know that can execute versus someone that is maybe a random one-off sign call that's calling about a one listing that they happen to have for sale. If they have to go sell a property, they're going to be very focused on making sure that whoever they're selling the property to can actually follow through and execute on the purchase. And they have a lot more trust built with someone like ourselves who has already executed on multiple deals within the marketplace, has built a long-standing relationship with them, likely has already done deals with them in the past, versus a new relationship or a one-off sign call that's calling about that opportunity. So
Yep.
the way we're seeing, making sure we're seeing the optimum deals or the best deals are coming across our plates is maintaining those relationships, whether it's with brokers themselves or sellers directly.
Yeah, I mean, Pike, I think we get that all the time. That was comprehensive. Just those relationships being maintained. We have a deal in contract right now that's a Scottsdale deal that we almost bought 3 years ago. I still have deals show up from 10 years ago, and we have a lot of our broker relationships are even longer than that. Being in business, at least in the Phoenix marketplace, for 18 years, we've done countless deals just based on reputation and name, where the brokers will call us and say, hey, here's a situation, here's a deal. We know you're a buyer for this. And as much as I'd love to think that every time a piece of real estate goes to market, it's a truly, independent process, we just know from experience it's not. Even the last deal we bought, the Murphy deal in Houston, we got preferential treatment on that. Not that anything unethical or anything like that, but the reputation of performing and executing precedes us. And that's within the brokerage community, not necessarily the sellers, but the brokers are the ones who influence the sellers. And when they can speak to the confidence in somebody's performance, it carries a lot of weight.
Like, I have a question.
Go ahead.
What's the first thing you look at in underwriting, and what kind of kills a deal the fastest?
Yeah, I mean, first things we're looking at is, hey, do we like the location, and does the opportunity fit our buy box or our investment thesis, right? That's the first filtration of our deal flow, because we're getting deal flow from a variety of sources and a massive amount of deal flow. And a lot of times it doesn't even fit our investment thesis, or it might not be in an area where we're focused or we're seeing the right macroeconomic fundamentals, right? So we're very much so first focused on location and the investment thesis itself. Then we start diving into the specifics of the deal, like the rent roll, upside in rents, the basis, et cetera. But I think the quickest way to kill a deal is, hey, it's not in a market of focus because it's maybe a tertiary market that isn't seeing the population growth we want to see, or rent growth is declining in that area, or not rent growth is declining, rents are declining in that area. So location and product type are going to be the first filter or the first lens that we look at deals through.
And then Pike, all right, this one's for Hanson. What's the difference between on market and off market, and why does that matter?
I think the kind of what I was speaking to a moment ago, on market is going to be a more competitive process than off market. So we've spent, it used to be $100,000 a month on mail. This is going back at least a decade. We've spent a lot of money over the years sending mail and working phones to do direct outreach to sellers, text message marketing, probably to an annoying extent in certain cases. But we went after those off-market properties because when we can have a captive seller and we're not bidding in a very public process, it usually is better for our pricing. So biggest difference, you hear about on market or off market a lot. The biggest difference is the less competitive the buy process is. Generally, we're going to be happier with our outcome. But, last month we just sent out the March activity pipeline. We had 800, and I pulled it up while you were talking about that, Pike. We had 803 deals received last month. Only 66 of those were fully underwritten, and we sent out 8 offers. So 8 offers on 803 means less than 1% of the deals that come through the door are worth writing offers on. That's a very small amount.
Another way, and to kind of tail off of Chris's statement on off market versus on market, there's a variety of ways. Like, you can get off market deals that aren't necessarily just directly to the seller as well. It might be something where a broker has been working on the leasing at the property for a long period of time, and the seller says, hey, I'm considering a sale, but I want someone that I know can perform. I'm not necessarily price sensitive. I just want this done, and I want it done discreetly for one reason or another. We do get off-market deals from brokers very frequently, or even
that California deal last year, Chris, the one up in the San Fernando Valley, right? The leasing broker came through our investor pipeline, had interest in our thesis, and then brought up, hey, here's a deal that you guys should look at. And it was an incredible deal.
Yeah. Or sometimes it's like a failed process. Maybe someone tried to sell their property through a public process that didn't work 2 years ago. And we stay in front of the seller as well as the broker, maybe that ran that process. And we can put ourselves in the right place in the right time to have an opportunity to pick it up in an an uncompetitive environment. So I think there's just an important differentiator is off market doesn't always necessarily mean directly through the seller only. Again, it just boils down to the relationship and putting yourself in the right place at the right time. I think in the fact that you're in a less competitive or a non-competitive environment.
Well, I think we're going to move on to the next slide here because I think we hit that one pretty. Oh, I'm sorry. You got one. How do you decide when to submit an LOI versus pass? What's the process look like there?
Yeah, I'm happy to jump in at least on the first phase of that, right? So we go through a pretty diligent underwriting process that really boils down to market data in the model, right? So you're going to run your model based on the existing data for the property itself, the rent roll, the in-place, verifying the in-place income and making sure then cross-referencing that with market data of like, okay, does the basis or the purchase price we're talking about in alignment with what we're seeing in the market? Are we able to beat or be at better than market pricing on a basis standpoint? Are our rents truly below market, and the upside that we're underwriting, is that truly achievable? And so we'll go through and work through the underwriting model to make sure that the returns that are getting spit out of our underwriting model are actually truly achievable. And then we'll go through the process of presenting the results of that to our investment committee to make sure that they're on board with, hey, do you like the location? Do you like the real estate itself? Is this something we feel good we could efficiently manage? And talk through every aspect of the deal and the underwriting to make sure that our team's comfortable with moving forward with an offer, so we have strong conviction in moving forward. Hanson probably has some additional insight, but that's kind of, at least from the acquisitions team side of things, that's what the process looks like on our side.
Yeah, I probably lean towards writing the offer. I'll temper the acquisition team's offer a bit through investment committee. If I have, some uncertainty on any components of it, I lean towards sending it. It never hurts to send the offer in. When we go, we send a lot of offers out relative to what we receive. So it's kind of like you're going to miss 100% of the shots you don't take. I have no shame in sending an offer that's 10 or 20% below the guidance that we hear from the brokers, because I don't think we've ever encountered a deal that we didn't then find something that justified being a little bit below where they start. Brokers are always going to start high. So our job is to kind of negotiate those guys to the realm we want to be. That gap between a seller expectation and our buying side expectation, we are able to narrow and navigate that to get both sides happy, several times a year. But if we were able to just write offers and never pass on things, we wrote offers on less than 10% of the deals that we saw. So I think that ratio is pretty good right now. If anything, we're probably too conservative, but I'm focused on our outcome more than the number of deals we do. I'd rather do fewer deals that hit home runs than do more deals that, start to whittle away at that result.
We're going to keep us moving to the next slide here. Pike, can you talk to us a little bit about your due diligence process and what that actually looks like day to day once you're under contract?
Yeah, so once you're under contract, a lot of times what we typically start with, or what we do start with before we start ordering third-party reports, is diving in on our assumptions in terms of downtime and construction costs, right? We'll go get our general contractors and subcontractors, such as a roofing contractor, to go inspect the roof. We'll have our general contractor come in and bid out the make-ready improvements for any existing vacancies or any upcoming leases where we're going to have to see some turn in the rent roll. And we'll make sure that all of our assumptions that we've underwritten align from a cost standpoint before we start spending additional third-party money, if time permits. Sometimes we have to pull the trigger on everything at once if it's a quicker moving process, but we try to phase in first, making sure that all of our underwriting assumptions on make readies and turnover and downtime and capital improvements in general are all accurate. If all of that checks out, then we'll start working with third parties on things like an environmental phase one, an ALTA survey, a zoning report, a property condition assessment, and getting eyes on it from specialists in each of their individual spaces to understand that we're meeting environmental regulations and don't have any issues showing up from the standpoint of whether there's easements or access issues, or there's, maybe a historical environmental issue, and we get third-party specialists involved on those. But that's generally how the start of the process looks like. Once we get into contract, it's really just diving in and verifying assumptions are accurate from the standpoint of improvements, as well as ensuring property condition is up to snuff, is kind of the first things we attack.
Perfect. We got a question that came in from Eric. It goes, I know you're focused on small bay multi-tenant, but will you look at a single tenant building that can be demised and repositioned?
I'll take that one, Ted. Yes, we do that exact business. The deal that Ted that's open at the company for fundraising today is in Chandler, and it is that exact scenario. It's 105,000 foot single tenant, and we've worked through with architects and engineers a demising plan that will convert it into 10 bays that range from about 7 to 13,000 feet. That's a business plan that we also executed last year. We're in our third industrial fund today, and McKemmy building in Tempe was a single tenant, about 45,000 feet. We demised it into 5 bays and executed the very plan. We're not opposed to single tenant business either. Most of our first industrial fund was actually single tenant stuff, more single tenant than multi-tenant. With where we are in the market cycle, we think there's way too many guys competing on those today. We're not seeing, although it's changing, we weren't seeing as much competition on the multi-tenant, small bay stuff, but that's where we think the biggest kind of inaccuracy in pricing today, where we see opportunity to go capture something below what it's worth, is with the multi-tenant small bay stuff.
Cool.
And to add to that, on the conversions, we take a lot of steps to mitigate risks on those deals if it is something that we're going to pursue. Like, for example, on the McKemmy deal that Chris mentioned, we were able to get an extended escrow timeline that allowed us to do a lot of the work on front end improvements and the leasing activity before we even had to close on that property, right? To help eliminate a lot of the risk. Same thing on the Chandler conversion. Like, we were able to do a lot of the front end due diligence in terms of, construction bidding and getting feedback from the municipality on the conversion, as well as, the fact that we're doing that deal in all cash rather than putting debt on it, in order to mitigate some debt risk that comes along with a pretty heavy lift from a redevelopment standpoint. So we do look at single tenant conversions, but we have to take into account a lot of mitigating factors in order to make sure that the yields are attainable versus buying, the lower risk buying existing that already has in place cash flow and doesn't require as much of a capital improvement lift. So we do look at those. And even on the single tenant stuff, if we buy a deal that makes sense as a single tenant deal, some of those are harder to get to pencil today because of the fact that, if you look at, 50,000 square foot single tenant building in certain submarkets, there's a decent amount of new inventory that can facilitate a 50,000 square foot user. So even if the deal looks attractive on a basis standpoint, once you start factoring in, if you're just running a pure single tenant execution, once you factor in downtime, make ready costs, et cetera, with the increased cost of capital and the significant amount of competition on these assets, it's been difficult to get the single tenant business plans to pencil from an execution standpoint.
That's a good point.
It's a pretty good segue into something we want to talk about next, kind of financing. And Hanson, how do you decide what debt structure fits a deal?
Debt structure is something we focus on a lot from the banking background. I think the main debate that most people talk about is either fixed or floating rate debt. We underwrite by basically creating a matrix of, we'll go solicit input from a bunch of the different banks or direct lenders that we work with, figure out what's possible given our business plan after we've kind of created a package or an opportunity summary. And then we have our analysts model each of those and basically take our full underwriting model and run all those debt assumptions out. So we might have 5, 8, 10, 15 different financing quotes. And that'll be not necessarily just fixed or floating, but what the prepayment would be, what the yield maintenance is, what the leverage is, because we're pretty good at math in our head, but a 65% leverage at one rate versus a 60% leverage at another rate is going to carry through over the course of our hold period to have a different outcome. So we make sure we've mapped every single scenario of all the debt. And then decide what we think aligns most with our expectation of the business plan. Obviously, there's a lot of things that come up and happen that aren't exactly as we plan on the way in. But having a wide range of outcomes and then putting our best, due diligence effort into figuring it out helps us end up with debt that aligns with our business plan, not just, hey, we got the lowest rate on this, and I think where the fixed versus floating comes back to it is a lot of times guys will take floating rate debt or non-fixed rate debt because of two things. They can get higher leverage, or they can get, well, generally it's higher leverage, but sometimes you can get a lower rate if you don't want a fixed rate. And maybe I'm getting conservative as I get older. I just don't use the floating rate debt unless I have just 100% certainty of execution and we want to play with that extra leverage for some reason. So I think if you lock in fixed rate debt, your business model works in that scenario. You map it out through execution. If that works great with fixed rate debt, even if it's a little more expensive, you don't end up in the situation that just bit a ton of operators the last few years when rates started rising, because a lot of those deals got done when debt was free. And then when rates went up, it just killed deals. I mean, 100% loss of equity. If you mess up your financing and you need more money and can't put it together, you're going to lose the deal, assuming you don't fire sale it sooner. So I don't see the risk or the benefit of taking that risk. So I like to stick to fixed rate debt, except in isolated scenarios.
So Pike, what does the closing process look like for investors, and what happens with their capital?
Yeah, so investors, in terms of what happens for their capital, like essentially the sponsor is going to collect their capital and accumulate capital until it's time for closing on an asset. And then the investor's capital is either it's prorated accordingly, whether, some of it's going to be held back for property operational reserve and capital improvement plans, as well as for operational costs and sponsor fees, right? All of that doesn't necessarily go to the title company for closing. So some of it's held back in an operational bank account for the individual asset, and some of it is sent to the title company as our equity contribution for closing, right? So essentially a LP investor, they go through the commitment process. They'll have a phone call, at least our own internal process. They'll have a phone call with Ted. Maybe they say that they decide they want to invest. They'll go through the process of completing docs, completing their accredited investor verification letter and submitting their wire. And then their wire is it's accumulated in a bank account for that specific asset, and the money's either sent to title as part of the closing proceeds or held with us as the sponsor as part of our property operating account for property reserves and improvements. I think that's straightforward enough.
No, that's perfect. Perfect. On closing, so at what point, Hanson, can you still walk away? And what are maybe some examples of when you've gone down the process, everything looks good, and then you get late in the process and realize it's time to walk away?
Yeah. So at closing or near closing, actually, this brings me to a deal I did like 10, 12 years ago, a multifamily deal where we walked away really late in the closing process. But I think at a high level, what you asked, at what point can you still walk away? I think you should always leave that on the table. The greatest money I ever get in real estate is earnest money that's been forfeited to me. So being on the other side of this transaction, when somebody goes hard on a deal and they can't close or decide not to close, and they donate $100,000 or $1 million or something, that money is great because it's pure to the bottom line at the asset. Being on the other side of that, I've walked away from earnest money once in my career, and we discovered fraud, and it's basically my fault because we should have caught it earlier. But it was a 390 unit apartment complex. And the week of closing, as we were working through kind of additional due diligence, we just kind of started discovering leases that didn't look legitimate. We'd gone through every unit at this property early in our due diligence process, and it was a Central Phoenix building, not a real high-end building. But having the discipline to go, hey, this isn't lining up. I'm relying on this information. We walked away. I donated $100,000 on that building. It sucked because that was a huge chunk of money for me. This is probably 2011, maybe 2012. But I would still stand by that decision. I mean, that building's probably worth 3 or 4x what it was then today, had I held it. But knowing what I knew at the time, I had to go with the information I had. And when I discovered fraud, I could choose to go fight the legal battle over that, and we argued and debated. We got some of the money refunded without having to litigate. We just canceled a deal a few weeks ago that we started raising money for in Tempe. It was a building in McClintock. So earlier in the process, to be at the other end of the spectrum, we put it under contract. We started getting our contractor bids in, and we underwrote it to have about 2x the renovation need of a very similar project we did, which we thought was conservative enough to get to the finish line. The contractor bids, specifically the electrical and the plumbing, both came in a lot higher than our trades initially estimated. We went out and got more bids. We weren't able to secure at numbers that would work for our business model. So we canceled the deal. I think that's always on the table to walk away, because pushing forward and pushing through and saying we're going to figure it out that's not the start of many good story or outcomes in real estate. You got to be disciplined. You got to know when things aren't lining up. What we want the model to say and what the model says should never be confused with each other.
Yeah, and I think another just quick tail on that too is like, you can, as Chris answered, the simple answer is you can walk away at any point prior to closing. Whether or not you walk away with your earnest money deposit is dependent on how you structured the purchase and sale agreement and in what phase you are within that purchase and sale agreement. Typically always going to have a due diligence or a feasibility contingency period, and if you walk away within that period, you have rights to your earnest, all of your earnest money back. If you find something after that period is up, like Hanson mentioned with the fraud that he came across on the apartment building that he did, then you have to make the decision: are you comfortable walking away from your earnest money, or and that's where he's standing by. It's worth that walking away from that money every time if you discover something late in the game that's detrimental to your underwriting.
Yeah, and that's not a regular occurrence. That's the one time in my career I've lost earnest money. I've collected it a lot more from buyers that struggle to perform. But yeah, not being scared to is the key.
On McClintock, we were well within our due diligence period, and we had 100% rights to our earnest money back. And so ideally, you work hard to catch every red flag you can while you're in that period.
But what's critical in that is working with a title company. We've worked with the same title group for almost 20 years, and having an escrow officer that's very capable and a known party. They're supposed to be neutral, and they act neutral. They're regulated by the state, but I'd rather know them than not know them. For those of you that are doing your own deals, it certainly never hurts.
Yeah, and trusting your third-party inspectors, right? You get all your third-party inspectors, your environmental specialists, your internal. We have an internal legal team that's cross-referencing or abstracting all of our leases, but making sure that you're very comfortable with your team, whether it's an internal team or outsourced teams, to make sure they're catching everything in a timely manner as well.
Keep it moving here. So let's talk about post-close and some of the red flags. So what happens the week after you close, Pike, and what does it look like as you take ownership?
Yeah, I mean, this varies pretty drastically depending on the asset type, right? Taking over a single tenant building versus taking over a multi-tenant business park with 100 different tenants looks drastically different, right? Like, just on the 100-tenant multi-tenant business park side of things, it takes some time for your property management team to fully transition that many tenants and onboard that many tenants, right? You're working to do everything you can to get that transition as smooth as possible, but the current ownership typically doesn't want to make the formal handoff until you've actually closed on the asset. So you don't get direct communication with all of the tenants until that closing has occurred. So a lot of times tenants in the first 30 days or maybe even the first 60 days are sending rent to their old landlord versus to the new landlord, and you're having to work on making sure that rent is going to the correct places. All of the, tenant requests, or if they have, a plumbing issue or maintenance issue, making sure that all of those maintenance requests are getting sent to the right place, making sure that, all of the operating expenses are occurring as they should during your underwriting, right? There's a major transition period of just taking over ownership from the property management side of things that takes a little bit of time to get your arms around if you're dealing with a large scale or a large amount of tenants at an asset versus like a single tenant building. You're typically dealing with a more sophisticated tenant that, you're only talking to one accounting team, and that transition becomes much easier. But on these business parks, it can take some time to make sure that, all your AR is aligned and heading to the right place. When I say AR, your accounts receivable and all the rent payments, et cetera, are going to the right place. All your operating expenses are going as planned. And then additionally, on top of that, not just from the property management's perspective, on the asset management perspective, you're starting to kick off work with all of your vendors for any sort of capital improvement plans. Maybe we start applying for permits, or we start, buttoning up or narrowing down, trying to get competitive bids to drive down pricing. We do all of our due diligence on contractor pricing while in escrow, but we may decide, hey, we want to get 3 more quotes moving and see if we can't drive this pricing down. So you spend the first, 30 or 60 days buttoning up and driving down pricing on your make readies and getting those kicked off as well. So there's a lot of moving pieces, especially in the multi-tenant side of things in the first 30 to 60 days post-closing.
Pike, that's where our scorecard process in our weekly asset management and property management team meetings, we work through a scorecard of kind of metrics or KPIs that we want to see. And it's, I think, at least from my seat of more observing than actually execution, seeing the weekly numbers on a chart that's automated and built into all of our systems so that our assistant property managers are reporting to the property managers. They're reporting to the director that's in the meeting, going over that stuff weekly. And we're looking at every single property and all those metrics week over week. And not just this week versus last week, but I mean an ongoing chart that builds over the course of the year so that we're actually seeing those trends and looking at it, not, monthly or quarterly saying what's happening, but as we're taking those on, we have expectations and underwritten kind of metrics where we want to see that those are actually being met and tracked. First, you've got to track it to make sure you're meeting it, right?
Yeah, and they're tracking things like occupancy percentages, collections,
inquiries,
looking at
leases out for application, like everything. Very minute.
Outstanding COIs that are not in compliance, like certificates of insurance that aren't in compliance, right? They're tracking a whole bunch of items and looking at changes over time. And our management team is looking at those weekly and reporting back to us. They're looking at it daily and reporting back to us weekly so we can project what's happening on a forward-looking basis, not just historically, like Hanson mentioned. And then even on the asset management side as well, we're looking at, okay, what was our budgeted, if we're looking at an individual make ready for a unit, what was our start date, what was our budgeted end date, and what was our contract pricing, and what is that in comparison to our underwritten contract pricing, and are we on budget and on time with this make ready, right? So we're looking at KPIs both from a property management and asset management perspective on a consistent.
Yeah, on Murphy, I saw or approved the monthly newsletter that's going out today. You have 20 bays under construction at the site that has 114 bays. And of those that are already complete relative to our underwritten budget, you were 147,000 ahead of budget or better than budget. That level of detail is a result. You start seeing it post-close. That's the post-close reality we're talking about, but that is the result of the due diligence and pre-close work that leads to that eventual result of we're leasing above underwritten rents, we're spending less than we underwrote, kind of all that, make sure. And I don't want to say we're going to spend 300 and then brag we spent 150. That's not it. It's, hey, we've got contingency for A, B, and C, and we were able to not use it or something like that. It's not that we didn't have good numbers. It means our outcome is exceeding what our worst case, and we underwrite to a worst case. That's part of being conservative.
We have a couple questions here from the audience. Pike, this one's a good one for you from Steven. Do you consider properties with yard space as part of the rent?
Slightly confused by the question, but I think what he's saying is, hey, do you incorporate the yard space into the rent roll, or do you charge for the yard space? And short answer to that is yes. More long-winded is it depends on, is this standard for buildings in the area? Like, what is the coverage ratio? Like, is the building make up only 10% of the total parcel, or is the building closer to 50%, which is normal, right? So if you've got a low coverage site with a whole bunch of excess yard space, you 100% need to account for revenue that can be created out of that additional yard space and incorporate that into your underwriting for what a property might be able to command from a rental rate standpoint. So I think that's what he was looking for.
Hanson, here's a good one for you. What's special about 7,000 to 13,000 square feet? What type of tenants? Why is it better than 2,000? Are they all warehouse, office, bathroom, dock door, or a storefront?
Yeah. 7 to 13,000, which I think he's referencing what I said on the Chandler opportunity we're working on right now. It's not that we made those specifically that for a specific reason, as much as we take a large rectangle, and with how the bay and dock doors are and all the other pieces, that made the most logical sense. We had to put a corridor or kind of a common access point. So that is in the sweet spot, of the small bays defined as 1 to 25,000 feet. Those just happen to be in the middle. The deal we did last year, that was the 45,000 or so split down to 5 bays, also ended kind of between 7 and 9,000 feet. That's been a nice area for us, but it was less by design than specific desire. I think it wouldn't be as efficient to chop those into smaller bays because it's a rectangular building, not a square. And you could end up with these long kind of bowling alleys if you cut them too narrow. It was really designed based around functionality, and I don't remember the other components of that.
Yeah, I can chime in there. I can chime in there too. It's a combination of not only functionality and like what you can actually make work, like what is actually efficient or usable for the end tenant, like Chris is mentioning, but you also got to factor in cost versus the lease rate that you'll get out of it, right? So it's like the cost to demise down to 2,000 square foot bays versus the rental rate could be significantly higher than what it costs to demise down to 10,000 square foot bays. And can you really drive enough extra rent out of those 2,000 square foot spaces in order to justify that additional cost? So it's a mix of things that are dependent on, hey, is this space actually functional or usable or attractive to the tenant base? And then two, what is the cost, and is the cost benefit analysis there in terms of what rental rates you can get? And it just happened to be at the Chandler building, it set up efficient units that were at a price point that made sense from us from a construction end of things. I think the point that's also to lean into there is the below 25,000 square foot spaces is important, because a lot of the existing inventory in terms of new construction that's on the market, a lot of those groups will demise down to, call it like 25,000 square feet. There's not that many groups out there that will demise their spaces down to 15,000 square feet or less, right? So we're hitting a market that's being underserved by being under, 25,000 square feet, and then combining that with functionality and layout and cost to kind of make that decision on how we chop up the bays.
Great detail.
Cool. Kind of get us back on track here to finish this last slide. Appreciate the questions though. Hanson, can you walk us through 5 of the red flags that are some of the bigger warning signs for any limited partners out there that are evaluating a sponsor?
Sure. Just starting with the one on the top of the screen, can't explain the buy box. If Chris or I, or even Ted for that matter, couldn't just walk you through exactly what the buy box is and why, as Pike just added all that detail on the specificity of why those bay sizes make sense with that kind of underwriting, you should probably question if you want to invest with them. Second, rushed or outsourced due diligence. A lot of groups try and win deals because they will offer a really condensed time frame of a short due diligence period. As a seller, if I have 5 offers on something, I like the guys that are going to be the quickest. If there's a 30-day due diligence or a 60 or a 90, I'm going to lean towards the shorter one. Where that can get guys in trouble is it takes a lot of time to do this stuff right, especially on these bigger parks where there's more people that need to be involved. To get through the 114 bays that we did on that Houston deal in December, it took a whole team of contractors, multiple days to get through that. Whereas we're looking at a 20 bay building in Scottsdale right now, and I think Chris said he had 15 people on site, or 14 or 15 contractors, going through every single bay, and that was only on 20 bays. You can't rush some of this stuff and get it done right. So if you're rushing through things, you're going to have problems. I'll be quicker. I think the biggest red flag here is just the aggressive rent growth. A lot of guys got really burned in multifamily, and we're a multifamily group. It's nothing against multifamily, but rents were rising so quickly for so long that supply chain or supply side grew. And a lot of the deals, because people would send me, I have a lot of friends who invest in real estate, and they'll send it to me and say, what do you think of this? And it's like gorgeous real estate, good sponsor team, everything's there, but their rent growth was based on rent growing 5% a year for the next 5 years or 10% a year. That's not likely sustainable. We know it's happened during different periods, but aggressive underwriting assumptions kills you so quickly. And that carries hand in hand with the debt that doesn't match the business plan. I kind of outlined earlier all those steps that we take to map out all the financing. And I mean, some of these different scenarios, I sometimes have to look and read through the spreadsheet a few times because it's like, man, what's the difference? Oh, this one had a 7-year maturity date instead of 5-year maturity date. What are the factors that might be impacting that? So a lot of times guys are just going to one place, they're getting a loan quote, they run with it, and it frequently doesn't match the plan. And lastly, the no clear execution plan. I don't think this is as common. I think a lot of the riffraff have been kind of washed out over the last couple of years with interest rate, but people who are just saying, hey, we're going to buy this, and there's not like a real value add lever that they're doing, like, hey, the rents are 40% below market, and here's what we're going to do to go change that. We like deals where we can force appreciation, and commercial real estate being valued on the income it produces. If you can't have a very intentional way to lower the expenses or raise the income, expecting a substantial differentiated value in a short time frame is just not realistic. I think I hit those pretty.
No, that's
thoroughly.
perfect.
Nailed it. Yeah.
We got a couple more questions from the audience. Pike, this is a good one for you. When you invest in a new area, do you hire property maintenance managers or hire and use internal staffing?
So, Nilesh, to answer that question, it goes back to how we're filtering deals at the front end, right? Like before we even submit an LOI, we assess whether we can efficiently manage a property in a specific area. And if we're in a new area that we haven't acquired before, we're always paying attention to, is this deal of large enough scale where we can efficiently manage the property? Because we don't want to buy a $2 million deal that we can't efficiently, with 20 tenants, that we can't afford to pay a property management staff to go and operate at that property. Like, we can't efficiently manage those deals. So, but in a market where we already own, maybe 500,000.
Houston.
Yeah, Houston,
for example.
For a proper area where we've already owned, 500,000 square feet, and we found a $5 million deal that, it had 10 different tenants that would be hard to manage if it were in a new market. Well, we already have boots on the ground there. We can manage it efficiently. We can bolt that on to a property or a portfolio that we already own in that area. So when it comes down to new areas, we're making sure if we're making our first acquisition in a new area, we're ensuring we're doing it at a scale where we can have the proper boots on the ground management infrastructure before we move forward.
But one more thing on that, when he said hire property maintenance managers or use internal staffing, we internal staff every sector of our real estate. We use external tax preparer, but we have CPAs internal. We have lawyers internal, acquisition, asset management, property management, accounting. Every piece of that is done by people that work with us every day. One, for the continuity of being able to do it, but two, we have one exception to that, and that is the actual leasing team. So while we have staff on site that works in Texas, full-time staff for us, they deal with walk-in traffic and leasing. Like at our apartment communities in Texas, the leasing and property management staff all work for us. In commercial, specifically on the small bay stuff, we want to be able to hire out the absolute best leasing or market leaders in any market. So when we're looking in Colorado or Utah, where we don't necessarily have on-site staff, if we can find the best leasing team to manage that, that's going to work. And we can use third-party vendors until we have a big enough footprint to justify on-site staff. So I think it's worth noting that we can operate in any market, but we're never going to operate if we can't do it efficiently. And that also comes back to multifamily. There's a reason large multifamily operators don't buy 40-unit buildings. It's because you just can't afford the staff required, because a property manager and a maintenance manager have a carry cost, and deferring that across 40 units doesn't work. You've got to defer it across 100 units or 200 units to make it work. So there's kind of a dead zone between something you can manage yourself and something that's institutionally viable. And we avoid those unless, as Chris mentioned, we've got the ability to share resources. And then those are some of the best deals, because we can go and operate with, the efficiency of a large deal's staffing structure, on small deal unit economics.
Here's one, Pike, this would be a good one for you. Is the ownership of the investment held in a unique LLC? And then how is the investor's investment secured?
Yeah, so we always set up an SPE or a special purpose entity for the ownership of the individual asset. The way the investor's interests are secured is that special purpose entity is then owned by whatever series within our fund that is acquiring that asset. So let's say Fund 3, Series 4, just as an example, owns 123 Main Street. So the asset itself is 123 Main Street. We'll create a special purpose entity called 123 Main Street LLC, which is then owned by Hanson Capital Opportunity Fund 3, Series 4. Right. And you, as the LP investor, are an owner of Hanson Capital Opportunity Fund 3 Series 4. Like, you have an LP interest in that specific entity. So your ownership interest is tied directly into the LLC that actually owns the asset itself. There's a little bit of a chain of entities that we create that's more for a liability standpoint, right? So if someone trips and falls and gets hurt while walking walking on our property, or tenant has a customer that gets injured and they try to sue both the tenant and us as the property owner, we create that special purpose entity to help create some limits of liability or layers of liability coverage. But you do own the entity that actually owns you own an LP interest in the entity that actually owns the real estate. So I hope I did that clearly enough. I don't know, Hanson.
I think that was great. Yes, you got direct ownership in the entity that's on title. That's how you're secured. And in addition, you're secured with the operating agreement itself that further kind of restricts or controls how we as the manager operate the real estate. And you can, the investors could replace the manager if they weren't doing what ownership requires and dictates.
Hanson, good one for you here. Are there challenges in the macroeconomic and finance environment that concern you the most going forward?
Yes, Michael, there are a lot of challenges in the macro environment that concern me. I think war is probably, the one that's top of mind for most of our economic reporting today. My thought is that'll be transitory. I believe that there is kind of an argument for some more inflation as we look forward. And I think there's also kind of an argument for some deflation right now. That being said, I'm mitigating that with our plan by being focused on cash flow. There's been phases in the investment cycle where people would focus less on what the cash flow was producing from an asset because they're saying, hey, we're going to make it up on appreciation. Just don't subscribe to that theory. I think the real estate needs to be productive. It needs to be spinning off cash. And when we're in an uncertain environment where we are today, I'm focused on getting our stabilized yields north of 8% because right now our money market funds are producing about a low 3. The last few years we've been getting lucky. We've been seeing 4 and 5% out of money market or savings accounts, with treasuries around 4 for a 10-year today. If I can stabilize real estate at an 8, I'll hold that all day. If economic conditions improve, cap rates come down, we'll make a bunch of appreciation. That would be great. If economic conditions worsen, values could get hit a little bit. But in theory, the levers I was just talking about, by forcing that appreciation, forcing that value improvement, by improving the operations and profitability, I think that gives me the downside protection, and I'll hold 8 yields all day long indefinitely. I think that's a solid return on capital.
Ryan's asking, this one would be a good one for Pike. How, if at all, are you looking to leverage AI when it comes to driving efficiency across the various phases of a deal?
And I'll
jump in, Pike.
I was gonna say we can talk about this for like an hour, like this, at least. Like, we could start a whole webinar on this, but
maybe the next one.
Go ahead, Hanson.
We've gone really deep with AI across many of the different departments. In fact, like our legal department has a project where we create legal tasks. Different sectors of the company add a task that needs to happen, from a lease or contract review or anything like that. We have an AI department. Our COO, Zach Price, has really gone head deep into the AI world. I've gone there with him a lot, and the efficiency that is being created, the ability to create systems that then are repeatable and scalable is creating meaningful change and lowering our costs of executing due diligence and then the ongoing administration I could see our property management operations becoming a lot more efficient. And I don't mean necessarily cutting headcount, because we've still got managerial level people, driving those ships, but the tedious and repetitive nature that comes through a bunch of the different sectors of our business are able to be not just outsourced, but I mean, really improved. The confidence of having things repeat from having technology as opposed to a person is mind blowing. I'm really excited about over the next 12 to 24 months to see where we're able to keep pushing it.
A simple example is like a lot of the reporting that occurs, right? So like if you want to understand reporting from what's occurring at, the people that are actually doing the property management work and what's happening within our own accounting system and translating that to our asset management reports, you can do that now in a click of a button through reporting that was set up and generated through AI agents, right? There's a whole bunch of, it's like one simple example, but there's same thing on outbound communication with our existing relationships. There's a bunch of stuff that we're digging into that we're very excited about.
Got about 3 minutes
But-
left, just a heads up.
One more thing that we did with AI recently is our enterprise accounting system, which deals with our tenant portals and our investor and all the math in between. We've had a $10,000 a month API integration set up for that. And with AI, we were able to connect like 3 or 4 different systems and create reporting that's far cooler than anything we've gotten out of the market leader. And Zach created it himself over a weekend, and it saves 120 grand a year. And that doesn't just save 120 grand a year for us at the company, that saves it at the partnership level. So we're implementing stuff routinely that is driving more efficiency. We get real excited about AI, but that's another talk, as Chris mentioned.
Hanson, is there a slide or discussion on the duration of the deal, when to hold a profitable deal, when to close or sell at the best timing?
I don't know if there's a slide. There wasn't a slide today on that, Michael, but as I mentioned, all those different scenarios where we run when we're picking the right debt for a deal, we do the same thing when we're running a disposition. So we get offers on our real estate, if not daily, at least weekly. We get a lot of non-solicited interest. So we have some calculators that our analysts are using and the asset management team is using, where we kind of run I say buy, sell, or hold, but obviously we already own it. The fourth category would be redevelopment, where our fiduciary duty is to maximize the return or the upside to our investors. So if we get a deal in or an offer in on a deal we own, we're going to go run an assessment and say, hey, here's our business plan. Here's what we think is going to happen over this duration. Here's this offer. If we sold today, this is the result it delivers. And we're going to look at, whole dollar returns as well as an IRR standpoint. But we're also going to look at what if we hold this thing another 3 years? What does that do? What if we scrape this property and redevelop it? What does that do? So we're looking at, again, every scenario that we can come up with so that we can make sure we're living up to our fiduciary duty of maximizing shareholder returns. And sometimes that leads to, outcomes that aren't necessarily what we want. And that's kind of what happened with that JP Morgan transaction. Awesome return, a 4x multiple during a very difficult time. But I would have preferred to hold that real estate. But when we ran it through that calculator, hey, here's what we get if we continue to execute, or here's what we get if we hold. We couldn't make sense of it. So we took an offer. Sometimes you've just got to take an offer because it's too good to say no to. That assessment is an internal one. And I think I hit all the pieces of what Michael asked there.
No, that was perfect. Cool. All right. Well, we're at overtime now, so we appreciate all the participation from the audience. If you're local here in Phoenix or Scottsdale, you're more than welcome to come visit us here. We're right in the center of Old Town Scottsdale. If you're elsewhere, we'd love to connect with you. So just reply to any one of our emails. Someone from our team will get to you, and appreciate the time and look forward to chatting later. Thanks, guys.